PantheonAI presents $46 trillion portfolio shift. Krispy Kreme Meme Stock, iRocket goes public. Welcome to the PAI Morning Briefing. I'm John, your host from PantheonAI, and today is July 23rd, 2025. Good morning, everyone. I hope you're all ready for a deep dive into the markets because we've got plenty to cover today. Let's just ease into it with a quick overview of where things stand right now. Starting with our major indexes, the S&P 500 is trading at roughly 6,309.62, with a modest percent change of about 0.0479. Meanwhile, the Dow Jones Industrial Average has climbed to approximately 44,502.44, reflecting a percent change of nearly 0.37. Over at the Nasdaq, we're looking at a level near 20,892.69, though it's experiencing a slight downturn with a percent change close to negative 0.4267. And don't forget about the Russell 2000, which is running at roughly 2,248.76, up by about 0.7879.
So, a bit of a mixed bag already, John, from the traditional indexes. What about crypto? Are we seeing similar trends there?
You know it, Sarah. Shifting over to the cryptocurrency sphere, Bitcoin is currently sitting at nearly 118,153.71, with a dip of approximately negative 1.5381, while Ethereum trails at around 3,652.16, down by roughly negative 2.5754.
Wow, so it really is a picture of mixed signals this morning, isn't it? We've got the traditional indexes, especially the Dow and Russell, quietly ticking higher, but then the tech-heavy Nasdaq has managed to slip a bit, and the crypto markets are showing some nervousness. It really makes you think about how investors are carefully balancing risk and reward across different sectors.
Absolutely. And speaking of balance, that actually leads us perfectly into a deeper discussion about the major market trends that are emerging. Because what we're seeing is this clear trend of cautious optimism coupled with an occasional bout of jitteriness. Many market participants are taking note that while traditional equity indexes seem to be flirting with gains, areas like technology and digital currencies aren't enjoying the same smooth ride.
That's a great point. And the slight uptick in the Dow Jones really suggests that investors might be gravitating towards more stable industrials and blue-chip stocks, seeking safe harbor amidst an environment where tariffs, trade policies, and evolving global uncertainties have everyone on their toes. Do you think this could be a subtle signal that economic fundamentals remain strong, even if sentiment in high-growth sectors like tech is wavering?
I'm inclined to think so, Sarah. While the disruption to tech and digital asset prices might be temporary, the underlying strength of the broader economy continues to support sturdy returns in core indices. And, many of you have been wondering, how do these trends fit in with the bigger picture of global investment dynamics? And that's where our comprehensive coverage of today's top stories comes into play. Let's break down the headlines that have been making the rounds this morning. First off, we've seen repeated news, and not once, not twice, but 3 times, about Asian investors facing an enormous portfolio dilemma. According to Morgan Stanley, Asian investors are now staring at a $46 trillion conundrum when it comes to allocating their assets, particularly with regards to their U.S. holdings. The concern here is that although the U.S. market continues to be a powerhouse, diversifying away from it is becoming increasingly important for these investors.
$46 trillion. That's an incredible amount. So they're really trying to strike a balance between tapping into the U.S. market's robust opportunities and avoiding an over-concentration in one geographical area. It's that classic case of don't put all your eggs in one basket, but with so many eggs at stake, the complexity of portfolio construction is heightened even further. Do you think these shifts could potentially reshape the global flow of capital?
I think so. It's a question that experts have been mulling over, and I suspect we're only seeing the tip of the iceberg. Equally compelling is another story that's been ringing in the corridors of finance. We've heard multiple times today that a veteran strategist, Lance Roberts from RIA Advisor, is sounding the alarm bells about an impending tariff-fueled correction. Roberts points out that the aggressive trade policies, notably those championed by former President Trump, although not the primary focus of news these days, could yet trigger a market correction.
That's interesting, and he's taken a rather contrarian view when it comes to big tech stocks, hasn't he? I heard he mentioned leaning away from historically stalwart Apple in favor of Meta platforms. That's a bold call. His argument hinges on the notion that, while tariffs and trade restrictions might weigh heavily on certain sectors, the technological revolution and the rise of artificial intelligence remain unstoppable forces that could provide counterbalancing momentum. It really makes you wonder, do we sometimes need a shakeup in our portfolios to truly tap into the next wave of innovation?
Absolutely. It certainly spices up the narrative. Then, turning our gaze to a story that weakens the gravity of mundane financial news with a bit of futuristic allure. iRocket, the next-generation reusable rocket developer, is set to go public via a merger worth roughly $400 million with BPGC Acquisition Corp., a SPAC backed by none other than the Honorable Wilbur Ross, the 39th U.S. Secretary of Commerce. This is a fascinating intersection of traditional capital markets and the cutting-edge space industry.
I love that story. In an era where investors are increasingly looking for the next big thing beyond terrestrial confines, this deal represents an exciting opportunity to participate in what could be the next frontier of commercial space travel and exploration. It really beckons the question, with such advancements, are we ready to see our market portfolios shooting for the stars, quite literally? And, on a more humorous note, do we need our own personal spacesuits to navigate this brave new investment world?
I might need one. And adding a quirky flavor to today's news, we also have the surprising entry of Krispy Kreme into the meme stock fray. Yes, you heard that right. The world-famous donut chain is now under the spotlight for reasons beyond just satisfying a sugar craving. Analysts at Capital.com, including Daniela Sabin-Hathorn, are noting that this meme stock rally is a testament to how market psychology and crowd behavior can sometimes set the course more than the cold, hard financial numbers.
That's incredible. While some may argue that shifting consumer tastes or market bubbles are at play, there's also a certain charm in seeing a beloved brand swept up in the digital frenzy that defines our era. It makes me wonder, in today's markets, can even a donut chain rise to prominence as a speculative asset? Or is this just a fleeting moment of social media infamy? And, on a lighter note, if the donuts start doubling as tradable commodities, will we need to carry change in quarters to keep pace?
That's a very real question, Sarah. Now, if you're keeping track, that's already 4 major headlines, each repeated in your feeds. But let's take a moment to recognize that what these stories share is a common thread of rapid change and shifting paradigms across sectors. Whether it's the dynamic between traditional fixed income and emerging technologies, or the tightrope that institutional investors must navigate in their global diversification strategies, the market environment is anything but static.
I'd say that the diversity in today's headlines, from the majestic outlook for space investments with iRocket to the mouth-watering spectacle of Krispy Kreme's meme stock moment, really underlines the fact that our investment landscape is as eclectic as it is global. And this brings us to our detailed sector analysis for today, where we can parse out which industries might be in the best shape to weather the storm and which might need a bit of a cushion.
Let's begin with the technology sector. It's no secret that the Nasdaq, which heavily features our technology giants, is showing signs of weakness today. While overall sentiment in the tech community remains buoyant given the rapid advancements in artificial intelligence and digital services, there's an underlying current of caution. Factors such as tariff-related trade policies, lingering geopolitical uncertainties, and regulatory scrutiny over data and privacy issues are causing some investors to hit the pause button.
Right. And yet, if past market cycles are any indication, these very disruptions could set the stage for a long-term rebalancing, one that might actually benefit tech innovators willing to push past short-term volatility. I mean, a slight dip might seem unnerving now, but it often paves the way for compelling entry points in a sector that continues to drive growth and innovation.
Couldn't agree more. Turning our gaze to the energy sector, although it might not be grabbing our headlines today, it's still a part of the broader narrative. Energy companies are navigating through a period of transition. The gradual but inevitable swing from traditional fossil fuels towards renewable sources is being felt across the board. As nations push for greener policies and investors become more environmentally conscious, companies that are proactive in adopting sustainable practices might just have the upper hand.
So, if you're sitting on any energy stocks, it might be time to examine not just where those companies stand today, but how agile they are in adapting to a cleaner, greener future. A smooth blend of old-world resilience and innovative green technology could turn out to be a recipe for success, much like a perfect cup of coffee on a brisk morning.
Love that analogy. Next up, we have the finance sector. Banks, investment firms, and financial services are adapting to an era that's increasingly dominated by digital transactions, fintech innovations, and a growing expectation for regulatory compliance. Institutional investors are realigning their portfolios in light of both domestic and international factors.
And that really ties back to the headlines we discussed, John. The news regarding Asian investors' $46 trillion dilemma shines a light on a broader theme. The rebalancing of global portfolios is playing a significant role in shaping market dynamics. Financial institutions that can embed digital technologies and maintain robust risk management profiles are likely to continue thriving. Meanwhile, with monetary policies in a state of flux across various economies, financial stocks need to stay nimble to capture the upside from both domestic stability and international opportunities.
Absolutely. And speaking of global market implications, the interconnectedness of today's financial systems means that an event in one corner of the world can quickly ripple across continents. The debates on how much exposure Asian investors should have to the U.S. market don't just affect one region. They have the potential to influence global capital flows. Similarly, policy decisions in one nation, such as those related to tariffs or trade agreements, can have wide-reaching consequences for the global supply chain. Investors need to ask themselves, are we sufficiently diversified to capture these global shifts? And in this age of uncertainty and opportunity, how can one best preserve capital while still seizing momentary gains? These are the big questions.
They really are, and our expert colleagues are grappling with them daily. While the market trends and sector analyses certainly provide a bird's-eye view, let's not lose sight of the micro-level intricacies. The repeated emphasis on the struggles of Asian investors with U.S. holdings highlights an important shift from a local perspective to a more interconnected global view. Morgan Stanley's insight suggests that rebalancing is no longer just a regional strategy, but a global imperative. It raises questions about what new destinations might become the go-to markets for these surging capital flows. Are emerging markets ready for this influx? And what regulatory or structural challenges might they face? These are the nuanced questions that keep us up at night, challenging our assumptions about traditional market hierarchies. And then there's the cautionary note from Lance Roberts regarding the potential for a tariff-induced market correction. While some might find his observations rather alarming, I believe his analysis comes with a healthy dose of skepticism about blindly following conventional wisdom. After all, every market correction, as painful as it might seem, has historically been followed by periods of remarkable recovery and innovation. It reminds me of the old saying that even a small leak can sink a great ship, but it's often alongside the discovery of innovative ways to build a sturdier vessel. Roberts' decision to pivot from a reliable technology giant like Apple to Meta platforms really underscores the idea that sometimes disruption can be an opportunity in disguise.
That's a fantastic way to put it, Sarah. And, we have to weave in some humor here. I can't help but chuckle when I think about Krispy Kreme joining the meme stock party. Imagine a board meeting at Krispy Kreme headquarters, where instead of discussing quarterly earnings, executives are debating how to price their donuts like smartphone stocks, with a volatility that could give roller coaster rides a run for their money. It's a lighthearted reminder that in today's market, sometimes the unexpected can capture the collective imagination of investors. And if a well-loved brand like Krispy Kreme can spark a speculative frenzy, then who's to say that the next big meme might just come from your local coffee shop?
Right? As we step back and look at the broader panorama, it becomes clear that while each story might seem distinct, together they underscore an era of transformation. The advancements in technology and innovation, whether in the realm of space travel with iRocket or in the ever-changing landscape of the digital economy, are forcing everyone to rethink investment strategies. Global diversification, risk management, and a readiness to embrace both loss and gain are becoming the hallmarks of a savvy investor's playbook.
So investors and traders out there, have you considered how these emerging trends might influence your asset allocation over the coming months? Are you placing enough emphasis on newer sectors like aerospace and technology? Or are you clinging too tightly to traditional blue-chip stocks? Perhaps it's time to ask yourself if your current portfolio is ready for a potential correction spurred by trade policies, or if you might benefit from diversification into emerging markets with robust growth prospects.
And before we wrap things up, let's take a final look at what these insights might mean for the near future. While the S&P 500 and Dow Jones are pointing to modest gains, it's worth remembering that markets are a blend of caution and optimism right now. The slight dip in the Nasdaq is a reminder that even titans of technology are not immune to headwinds, be they regulatory, geopolitical, or trade-related. And then there's the volatility in digital currencies, which, although not part of the mainstream indexes, still play a significant role in the overall market sentiment. As a seasoned investor, one always has to weigh potential risks against long-term rewards.
In summing up our detailed sector analysis and global market implications, I'd say that the industries leading the charge through this dynamic period, technology, energy, and finance, all have their individual success formulas. Tech may be riding a bit of a roller coaster, energy is in a state of transformation towards sustainable practices, and finance is evolving amid the digital revolution and global capital realignment. Experts predict, and I tend to agree, that while short-term volatility is on the horizon, the long-term trends remain promising for those who can navigate the fluctuations with a measured approach.
As we bring today's conversation to a close, let me leave you with some thought-provoking questions. Are we truly prepared for the global shifts in capital flows, especially in light of the sizable challenges faced by institutional investors in balancing U.S. exposure with opportunities elsewhere? How can individual investors harness the lessons from both cautionary tales like the tariff risks and the bold moves in technology and space industries to construct a resilient portfolio? And finally, in a market where even donuts can turn into stocks worth watching, what does that say about the evolving nature of investor sentiment and market psychology?
Those are not simple questions, Sarah, and they're exactly the kinds of topics that make our daily conversation so riveting. I invite you all to mull these over as you go about your trading day. After all, investing isn't just about crunching numbers. It's also about interpreting narratives, understanding diverse perspectives, and learning how various factors interlace to form the big picture.
Remember, we're here at PantheonAI to act as your information copilot, guiding you through the sometimes tumultuous yet always fascinating world of finance. If there's one takeaway from today's briefing, it's that while markets evolve, the need for informed perspectives remains constant. Engage with these trends, ask plenty of questions, and do not hesitate to reach out to our AI copilot with your queries, because in our community, learning shouldn't feel like a full-time job.
That's right. Thank you for joining me and us on this detailed journey through today's market updates, major trends, and compelling news stories. I hope you found our conversation engaging and that it has provided you with valuable insights for your investment strategy. Tune in again tomorrow for another round of in-depth market analysis and fresh takes on the stories shaping our financial world. Until then, take care, stay curious, and remember, learning shouldn't feel like a full-time job.
PantheonAI, your information copilot.
Because learning shouldn't feel like a full-time job. Take care and see you next time.